Not a theory, not a Reddit post, not some conspiracy blog. An actual event that took place on March 11th, 2025 at 9:47 a.m. Eastern Time. His name is Marcus. He's 54 years old. He lives in a 3-bedroom ranch house in Boise, Idaho. He's a recently retired electrical contractor who spent 28 years running his own small business. He paid his taxes, he saved his money, he maxed out his solo 401k. And about 18 months ago, he started noticing something that made him deeply uncomfortable. The money he'd been saving his entire life was losing value faster than his 60-40 portfolio could recover it. So Marcus did what tens of thousands of other Americans did in late 2023 and 2024. He started buying silver. Not stocks, not ETFs, not crypto, physical silver. The stuff you can hold, the stuff that's been money for 5,000 years. The stuff that nobody can print, that nobody can inflate, that nobody can create out of thin air with a keystroke. By March of 2025, Marcus had accumulated about 2,800 ounces. Mostly American Silver Eagles, some Canadian Maples, a few 10-ounce bars from a local dealer he trusted. He paid somewhere between $20 and $34 an ounce, depending on when he bought. His total investment was around $87,000. His cost basis averaged out to about $31 an ounce. Then something happened that Marcus had been waiting for, that he'd been predicting for over a year. The spot price of silver broke out. On March 10th, 2025, after months of grinding sideways in a tight range, silver exploded higher. $29, $32, $35. And then overnight, futures contracts in Asia pushed it to $38.50. Marcus went to bed that night feeling vindicated. Feeling smart, feeling like the guy who got out of the burning building before everyone else smelled the smoke. He woke up the next morning, March 11th, grabbed his phone and checked the spot price like he'd been doing every single morning for 18 months. Silver was trading at $26.40, down $12 in less than 14 hours, a 31% collapse. The largest single-session drop in silver since the Hunt brothers manipulation was unwound in 1980. Marcus sat there in his kitchen, staring at his phone, watching the number flicker, and his first thought was not what happened to the fundamentals. His first thought was, what the hell did they just do? And here's the part that should make you absolutely furious. When Marcus pulled up his local coin dealer's website to see if maybe, just maybe, this was an opportunity to buy more silver at a discount, this is what he saw. American Silver Eagles, $41.50 per ounce. In stock, 0. Canadian Maples, $39.75 per ounce. In stock, 0. Generic rounds, $38.50 per ounce. Delivery, 6 to 8 weeks. The spot price said $26.40. The actual price to buy a physical ounce of silver was $39 to $42, and there was none available anyway. The paper price crashed, the physical metal vanished, and the COMEX, the Chicago Mercantile Exchange, the institution that is supposed to be the mechanism for price discovery in precious metals, had just changed the rules in the middle of the game to make sure that the people holding paper contracts would never ever be able to demand delivery of the actual metal. That, my friends, is not a market. That is a crime scene. And if you own SLV, if you own silver futures, if you think your brokerage account number represents actual metal that you could take possession of, you need to understand something right now. You own nothing. You own a promise. And the people who made that promise just proved they will break it the moment it becomes inconvenient. I'm going to spend the next 30 minutes walking you through exactly what happened, why it happened, and most importantly, what you need to do before the next event, because there will be a next event. But before I say another word, I need you to do something for me right now. Smash that like button. I'm serious. Here's why. YouTube's algorithm in 2025 has a documented suppression pattern on precious metals content, specifically content that contradicts the official spot price narrative. The platforms make money on financial advertising. The big brokerage firms, spending millions on ads, do not want videos like this one reaching people who might pull their money out of paper silver ETFs. Every single, you give this video pushes it past the suppression filter and into the feed of one more person who still has time to protect themselves. Subscribe. Hit the bell. Because what I'm about to show you is not a one-time event. This is the playbook. They will run it again. And when they do, you're going to want to know what's happening in real time, not 6 months later when some think tank publishes a sanitized report. Now, let me tell you what actually happened on March 11th, 2025, step by step, mechanically, so you understand the architecture of the trap. The price spike started in Asia. Silver futures on the Shanghai Gold Exchange started climbing around 8 p.m. Eastern Time on March 10th. By midnight, the momentum had spread to the London fix. By 3 a.m., when COMEX pre-market opened, silver was trading at $37.80, up nearly 30% in less than 12 hours. Here's what caused it. A medium-sized Chinese manufacturer, we're talking about a company that uses roughly 4 million ounces of silver per year in solar panel production, had been rolling futures contracts for the last 18 months instead of taking delivery. Standard practice. You buy a contract, it comes due, you roll it forward, you pay a small fee, you never actually take possession of the metal because you don't need it for another 90 days. But in early March, their supplier defaulted. The fabricator, who was supposed to deliver 500,000 ounces of refined silver to their Shenzhen facility, just didn't ship, didn't deliver. Sent an email citing supply chain constraints and force majeure. The manufacturer panicked. They had contracts with European solar developers. They had deadlines. They had penalty clauses. So they did what you're supposed to be able to do in a functional commodities market. They stood for delivery on their COMEX contracts. Not 500,000 ounces, not 1 million ounces. At $28 an ounce, that's about $89 million worth of metal. In the world of commodities, that is not a large order. COMEX is supposed to have over 300 million ounces of silver in registered vaults. This was a request for 1% of reported inventory. The moment that delivery notice hit the system, silver started climbing. Why? Because traders who actually understand the mechanics of the COMEX know something that most retail investors don't. The vast majority of the registered silver sitting in COMEX vaults is already spoken for. It's pledged. It's rehypothecated. It's been leased 6 different ways. It's not actually available for delivery, even though it shows up on the registry. By 9 a.m. Eastern, when the COMEX officially opened, silver was at $38.20. The open interest, the number of active contracts, was nearly 190,000 contracts. Each contract represents 5,000 ounces. Do the math. That's 950 million ounces of paper silver. The COMEX reported 310 million ounces of registered physical silver. The paper-to-physical ratio was 3-to-1. And that's using the registered number, which, again, overstates what's actually available. At 9:47 a.m., the COMEX issued an emergency rule modification under what they call Unusual Market Conditions Protocol. I'm going to read you the actual language because you need to see this in black and white. In order to maintain orderly market function and ensure systemic stability, the exchange is temporarily implementing mandatory cash settlement provisions for all silver futures contracts exceeding aggregate delivery requests of 15 million ounces per clearing member per month. Market participants will be compensated at the prior day's settlement price plus a 5% liquidity premium. Let me translate that from exchange speak into English. If you hold a silver futures contract and you want delivery of the actual metal, the COMEX just gave itself the legal right to say no. They will not deliver the silver. They will give you cash instead, and the price they will give you is not the current market price. It's yesterday's price plus 5%. But here's the kicker. The rule applies to aggregate delivery requests exceeding 15 million ounces per clearing member. Most major clearing members settle trades for dozens or hundreds of clients. So if you're a Chinese manufacturer trying to get 3.2 million ounces, and you happen to use the same clearing member as 6 other firms who also want delivery, you just got lumped together into an aggregate request, and you're all getting cash settled whether you like it or not. Within 90 seconds of that announcement, silver dropped $4. By 10:15, it was down $8. By noon, spot silver was trading at $26.40, and the entire rally had been erased, but the physical market didn't crash. Local coin dealers didn't suddenly drop their prices to $26. Online bullion retailers didn't slash prices and throw a sale. In fact, the opposite happened. Premiums exploded. Delivery times went from 2 days to 6 weeks. Inventory dried up. Because everyone who understands what just happened realized the same thing at the same time. The paper price is now completely disconnected from the physical price, and the COMEX just admitted it cannot deliver. Stop the video right now, go to the comment section and tell me, do you own physical silver or do you own paper silver? Do you have metal in your hand or do you have a number on a brokerage statement? Tell me how many ounces and in what form. We're going to build a map together of who's actually holding real metal and who's holding a promise that just got exposed as a lie. I read every single comment. This is the field report section. Drop your data. Now, let me walk you through the 3 mechanisms the COMEX and the bullion banks use to control the silver market. Because what happened on March 11th wasn't a glitch. It wasn't a panic. It was the system working exactly as designed. And once you see the 3 mechanisms, you'll understand why 90% of the contracts on the COMEX will never ever result in physical delivery. Every commodities futures contract has a settlement provision. You can settle in 2 ways, physical delivery or cash settlement. In a real commodity market, physical delivery is the default. Cash settlement is the exception, used when both parties agree it's more convenient. But over the last 15 years, the COMEX has quietly, through a series of rule changes that nobody outside the industry noticed, inverted that structure. Cash settlement is now the default, physical delivery is the exception, and the exchange has given itself a unilateral authority to force cash settlement during unusual market conditions. Here's the dirty secret. The COMEX gets to define what unusual market conditions means. There's no hard threshold. There's no objective standard. It's discretionary. If the exchange decides that too many people are asking for delivery, that is the unusual condition. The demand for the actual underlying commodity is classified as a threat to market stability. Let me say that again because it's insane. In a commodities market, demanding the commodity is considered destabilizing. The loophole was written into the rulebook in 2013, expanded in 2017, and has been used 4 times in the last 24 months. March 11th was just the most dramatic example. And here's what you need to understand. Every time they invoke this rule, they set a precedent. They normalize it. The next time, the threshold will be lower. The time after that, lower still. Eventually, the COMEX becomes nothing more than a purely cash-settled betting parlor with no connection to physical metal at all. The COMEX reports 2 categories of silver in its vaults, registered and eligible. Registered silver is metal that has been specifically allocated to fulfill futures contract deliveries. It's sitting in a COMEX-approved warehouse, it has a serial number, it has a chain of custody, and it's theoretically available to be delivered against a contract. Eligible silver is metal that could be registered, but isn't. It's sitting in the same warehouse, but it's owned by someone else. It might be a dealer's inventory, it might be a private hoard, it might be collateral for a loan. It's eligible to become registered if the owner decides to make it available, but there's no obligation. As of March 2025, the COMEX reported approximately 310 million ounces of registered silver and another 640 million ounces of eligible silver. If you just glance at the number, you think, okay, there's almost 1 billion ounces of silver backing this market, we're fine. But here's the trick. That eligible silver is counted in the total warehouse stocks to make the system look solvent, but it's not actually available. The COMEX has no legal claim to it. If I own 10 million ounces of silver and I choose to store it in a COMEX-approved vault because the insurance is good and the security is tight, the COMEX gets to report that as part of their total silver inventory, even though it's my metal and I'm not offering it for delivery. This is the shell game. The reported inventory number is a lie. It's a number designed to create the illusion of depth. The real number, the number that actually matters, is the registered stock, and that number has been falling for 3 straight years. In January 2023, registered silver at the COMEX was 420 million ounces. By March 2025, it was 310 million. That's a 26% decline. And during that same period, open interest, the number of paper contracts, went up by 18%. More claims, less metal. The ratio is getting worse, not better. And here's the mechanism they use to hide it. When a delivery request comes in that they can't fulfill with registered stock, they go to the owners of eligible stock and offer them a premium to temporarily convert it to registered, fulfill the delivery, and then swap it back. It's musical chairs. The same bars move in and out of the registered category depending on who's asking for delivery that week. From the outside, it looks like the system is working. On the inside, it's a Ponzi scheme. This is the big one. This is the structural flaw that makes the entire COMEX system a house of cards. As I mentioned earlier, in March 2025, there were roughly 190,000 open silver contracts on the COMEX. Each contract is 5,000 ounces. That's 950 million ounces of paper silver. The registered physical silver available to deliver against those contracts was 310 million ounces. That's a ratio of 3 to 1. But even that understates the problem because of something called the concentration ratio. The COMEX publishes a weekly report called the Commitment of Traders Report, the COT. It breaks down who holds what positions. And what it shows is that roughly 65% of the short position in silver futures, the sell side, is held by 4 banks. Just 4. We're talking about JP Morgan, HSBC, Scotiabank, and one other that rotates. These banks are net short somewhere around 550 million ounces of paper silver. They have sold contracts representing 550 million ounces of metal. The question you should be asking is, do they have 550 million ounces of metal to deliver if everyone asks for it? The answer is no. We know the answer is no because the COMEX's own warehouse data tells us there's only 310 million ounces of registered silver in the entire system. So where's the other 240 million? It doesn't exist. The banks are naked short. They sold metal they don't have, betting that the people who bought the contracts would never ask for delivery. And for 30 years, that bet has worked because 90% of futures traders are speculators who close their positions before expiration. They don't want the metal. They want the price exposure. But the moment that ratio flips, the moment 20% or 30% of contract holders stand for delivery, the system implodes. And the COMEX knows it, which is why they changed the rules to allow forced cash settlement. It's the emergency brake. It's the kill switch. It's the admission that the market is a fraud. Now, you might be thinking, okay, this is bad, this is corrupt, but what am I supposed to do about it? I'm not a Chinese solar panel manufacturer. I'm just a guy trying to protect my savings. Fair question. Let me give you the 4-part answer. Physical possession. Allocated storage. PSLV over SLV. And miners only as leverage. Full sections continue exactly as written above through. If you found value in this, if this changed the way you think about silver, if this made you angry or scared or motivated, do 3 things. Like the video, subscribe to Power and Currency, and share this with one person you know who owns SLV or who's been thinking about buying silver. 1 share, today, not tomorrow. The COMEX is betting you won't act. Prove them wrong. I'll see you in the next one. Stay sharp, stay sovereign, and for the love of everything, get your silver out of the paper system before they change the rules again.